The clock might be ticking on your dream of buying a new home. You see, there's a little known program that might allow you to get that house you've had your eye on and 2021 interest rate. But be warned, time is running out. This is a program that not many people know about, and the best part is you get your interest rate at a fraction of what's in the normal market, making housing affordable for many. But here's the catch. It's realistically only going to be available for a limited time. It's called the 2-1 Buydown. And in this video, I'm going to show you exactly what you need to know about eligibilities, pros, cons, and even some of the risks so you can make sure you're making the right decision. But that's not all. We'll also be sharing some insider tips so that you can use this program, get you your dream home before it's too late. So if you're ready to stop dreaming and start owning, make sure to watch till the end of this video, because trust me, it's gonna be worth it.
Boom, boom, boom.
So here's how the program works in essence. What you do is you have the seller credit you funds, but instead of just using those credits for closing costs, you use those credits with this lender program to set aside those funds and help you have a lower payment. Here's what I mean. So in a scenario as a $800,000 purchase price with 20% down, your loan amount would be $640,000. That means that if your note rate is at a 6.625%, the 2-1 Buydown allows your first year payment to equal as if your rate was 4.625%. And the way that takes place is that those funds set aside go towards making up the payment difference. So in year one, your payment should be $807.50 lower. So therefore, every month from this account, you're drawing $807.50 lower. Remember, this account was paid by the seller. So the seller is helping you offset this payment. Once 12 months is completed, that second set of 12 months now moves you from that 4.625 to the 5.625. And now you're drawing $413.79 to make your lower payment effectively in that second year equal 5.625. Now, after year one and after year two are completed, all the funds are utilized. And now in year three, you continue making your payment at that full note rate of 6.625% if you never refinance. And as we all know, in any good financial plan, you want to always identify your exit strategy. So if you don't refinance, your payment is going to be at that full amount with nothing to subsidize it. Yet, imagine what happens between you getting the house and now 2 years completed. You knowing that there's a chance of you now having the higher payment, first of all, realize you still have to qualify for that higher payment. Second, make sure that you just don't assume you're going to refinance, but prepare. So let's say you don't refinance. What can you do to make sure your family is still in a good position? Number one, always look at your monthly expenses. Are there any other debts that we can work on paying down? So by the time this loan does hit that full monthly payment, your monthly budget hasn't changed a lot. Paying down those other expenses and debts and relieving that cash flow can allow you to hedge yourself so that if you don't refinance, you can still be in a really good position. In addition, if you don't refinance because rates are skyrocketing still, guess what you're going to be really grateful for if you buy now and lock in that rate instead of wait till later? You're going to be really grateful you got that lower rate. The interest you pay on this can be potentially tax deductible and beneficial varying on situations. All that to say, let's go back how to actually ensure you execute on this well. First and foremost, different loan programs are going to have different restrictions on how much credit you can get from the seller. And variance in down payments can affect that max amount too. So on a conventional loan, let's say you're on a primary or a second home purchase. If you have less than 10%, you can only get 3% attributed to you in seller contribution. If you have 10 to 24.9% down, you can have up to 6% attributed to you in contributions. And if you put more than 25% down on a conventional loan as a primary purchase or second home, you can have up to 9% attributed to you in Buydown. And don't forget this, typically having credit given to you makes your monthly payment cheaper than just getting the purchase price at a lower amount. FHA allows your max contribution from the seller to be about 6% right off the bat, no matter what your down payment is. So if you have low down and you're looking at an FHA loan, realize you have some of the biggest opportunity to utilize and optimize the credit you can get from the seller. VA varies, but a good rule of thumb to have for safety would be about a 4%. Even though, again, that could vary in addition. So how do you make sure you strategize to get this in full benefit? Finding the right team is crucial here. So when you're looking for a lender, make sure you identify what kind of buying down options do they have. Do they have a 2-1 buy down? Do you have a 3-2-1 buy down? Does it allow for anybody else outside of the seller to be the contributing factor there? Analyzing all that is super important. Then identifying how are they going to help make your offer look good to the seller. Because if you can't convince the seller to give you credit, or if they think that your transaction doesn't have good financial strength, you can have the theoretical 2-1 buy down all day long, but you won't be able to execute on it. So having a lender who called the listing agent, knows how to clarify this program so that you can benefit is crucial. And in addition, having in collaboration a good real estate agent who knows how to write up the contract specifically so that you can avoid potential issues in that legal manner with the loan or the transaction, and knows how to work well with a lender so that both of them can present you to the seller in such a way that you win is imperative. So how do you get started? Number one, identify your qualifying power. And number two, identify what neighborhoods with your realtor have homes staying on the market a longer period of time, because those are usually the ones you can actually negotiate the credit you need to make this wonderful program possible. And here's the last tip to consider. Many people miss out on opportunities because they assume those opportunities are always going to be there. As soon as this market moves and we see rates go down, which is extremely probable and likely in my personal opinion, we are going to see everyone kick into FOMO gear. And that type of competition is going to take away the incentive of the seller to even try to negotiate credits like this in. So assuming that if you want to buy in 6 months, that this strategy might still be available to you, might be the one assumption that makes you lose out on affordability of your next dream home. So don't let this chance pass you by. If you've been on the fence of buying a house, now is the time to take action. The fear of missing out is real, and the opportunity to secure a 2-1 buy down might not be an opportunity you get again. Like, subscribe, and share, and I'll see you in the comments section.